Good morning, everyone, and thank you for joining us for today's free webinar, Seed Funding Your Startup, with Christine DiBacco from Fenwick & West and Cirque Rowe from Early Growth Financial Services. My name is Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run about 40 minutes or so. If you have questions as we go along, please don't just raise your hand. Feel free to enter them into the question field, and we'll answer them as we go along if we can. Also, if you have leftover questions after the presentation, you can always tweet them to us at earlygrowthfs with the hashtag seedfunding. We will address questions as we go or at the end of Q&A, and if we run out of time, we'll be sure to follow up with you so you can have all your questions answered. We'll also be sending an email tomorrow that will have a link to this slide deck as well as a link to the recording, so you'll be able to access this information after the presentation. I want to start today by introducing Christine DiBacco. Christine is an associate with Fenwick & West LLP, where she focuses her practice on strategic counseling to emerging and high-growth companies, primarily in the internet, social networking, digital, mobile health, and digital media industries, in all aspects of general corporate and corporate securities law, from formation and corporate governance matters to intellectual property and commercial transactions to equity incentive plans and employment issues. She has negotiated and structured a wide variety of corporate transactions, including seed and venture capital financings, debt financings, corporate reorganizations, mergers and acquisitions, and initial public offerings. In addition, Christine has also represented and advised several leading venture capital firms investing in technology companies. So we're very pleased to have you here with us today. Welcome and good morning to you, Christine.
Thanks, Erica. Glad to be here.
And we also have with us today Cirque Rowe. Cirque is the Chief Operating Officer for Early Growth Financial Services. He has 25 plus years of finance experience with 17 years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. So good morning and welcome to you, Cirque.
Thank you, Erica, very much. It makes me sound old.
Not at all, not at all. So before we dig into the agenda, Christine, would you mind telling the listeners just a little bit about Fenwick & West?
Sure. For those of you who don't know us, we are an indigenous firm to Silicon Valley. We are focused on working with technology companies. We're headquartered in Mountain View, although we do have offices in San Francisco and Seattle. And we have a we're a full service provider for technology firms. So I'm in the corporate group, but we have intellectual property attorneys, we have litigators, we have tax attorneys, and so we're able to help technology companies with all the different stages of their growth and the issues that they come across. So we love working with technology companies. I'm focused on the private side, so startup technology companies from the time we incorporate them through to their sale or IPO and all the fun that happens in between.
Awesome. Thank you, Christine. And Cirque, you want to just say a few words about Early Growth Financial Services?
Yeah, thanks, Erica. Early Growth Financial Services, we are a national financial and accounting outsource firm. We work with early stage and small and mid-sized companies, and we assist them in basically four primary areas. We do tax returns, corporate tax returns. We do 409A valuations for companies who are giving stock options to their employees. We do transactional, financial, and accounting and bookkeeping work. That's the day-to-day, week-to-week, month-to-month accounting that has to happen, as well as financial reporting. And then we also provide CFO-level services for higher-level things like budgeting and financial planning and pricing and customer acquisitions and looking at debt and looking at equity and fundraising and those types of things. We have offices across the country in many of the major cities, especially those cities with startup companies. We have 300 plus active clients that we work with. And we work very, very closely with the early stage companies to help them grow on an as-needed basis.
Wonderful, thanks. So we have a lot to get to today, so without further ado, I'll hand it over to Christine to jump right in.
Sure, so let me just outline for you briefly what we'll cover this morning. We'll talk a little bit about bootstrapping and why companies might do that, how they move from that to taking on investment money, how you can prepare to take on your first round of investment, and the different ways you could structure that first investment round. And we'll talk specifically about convertible debt, or promissory notes as people call them, and Series Seed preferred stock, SEED, and that is a relatively new phenomenon. It's kind of a mini Series A, and it's a pretty efficient way to bring in money. And we'll also give you some sample term sheets so you can have those to look at later. Great. So bootstrapping, this is something many founders do at the very beginning of a company. They fund the company through savings, maybe very informal loans from family members, and they don't take on outside investment at the beginning. At least many of my companies don't. I think it's a good thing if founders can do that, because until you take on investment money, you don't have the dilution that comes along with that. That being said, I appreciate that it's a stressful time as well if you're having to dip into savings and use your credit card. So I think there's a balance there between, putting off an investment, but maybe not for too long if it's causing you, personal financial stress. One of the things I would say about the bootstrapping stage is, hopefully you have an actual corporate entity by then, and you should, if you want to be the kind of startup that we're talking about, be a Delaware C Corp. And it's very important, even when you don't have outside investor money, that you keep your finances, your personal finances, separate from the company. So you need to treat the company as its own entity. It needs to have its own bank account, its own credit cards, checks, all that stuff. And that's very important both from a accounting record-keeping perspective, which investors care about, but also from a liability perspective, because while the corporation does give you protection against personal liability, that protection will not exist if you really fail to keep up with corporate formalities and don't treat the entity like a separate entity. So even at the very early stages when you're bootstrapping your company, just be sure to really treat it separately and keep up with all those corporate formalities. Sir, did you want to add anything there, or should we?
No, those are the main things. But also, on the other side of it, Christine talked about the fact that obviously it's a little bit uncomfortable from a bootstrapping perspective on your financials, but also from an investor perspective, and we should be thinking about how much are we going to get done with the bootstrapping before we go outside to investors? But there's also a negative also to continue to fund your company by yourself for a long, long period of time and for a lot of money. Because I raised the question in the investor's mind as to, well, why did it take so long for you guys to come out and look for investment? Were you not able to find investment early on? And so those things also need to be taken into consideration in addition to just personal finances.
I think that's great. Yeah, and I think some people are hesitant to take on investor money because they think they can do it on their own. But you will suffer the dilution, but you also have a lot more money to really grow your company. So I think you need to balance all those factors. Okay, so once you decide you're going to take on outside investment, how do you do that, and what does that look like? I think one of the first things we see people do quite often is a friends and family round. So they will reach out to, people in their lives that are close to them, and they will use those funds to get the company going. That is usually a much smaller investment size, both on an individual level and also sort of in terms of how big the round is generally, than we would see if you were going to go out to maybe professional angels or even VCs who are doing seed stage investments. So we do see lots of friends and family rounds done. Some people are not great about papering them. I've had founders come to me and they say they've taken money from their wealthy uncle or parents, and there's been no documentation around that. I really would avoid doing that if at all possible, because you should be documenting that money as it comes in and papering it, and you can do it in a pretty efficient way. So you definitely want to be doing that. I think you also, when you take in friends and family money, need to be very aware of your personal relationships with these people and the fact that investing in these types of technology companies is very, very risky, and you need to make sure that the people who are doing that understand that and can frankly bear the entire loss of the money that they're giving to you, because you have to face these people at Christmas and holidays and throughout your life, so you want to feel good about what's their investment and what's happened. So I just think it's really important to make sure you aren't taking money from people who really can't afford to give it to you, and you're very upfront with them about the risk.
I think this photo in this slide is perfect. I mean, think about it in this perspective. I mean, you're going to be sitting across the table from them over Christmas and over Thanksgiving, and you have to ask yourself, okay, if I lose this entire investment from my friend or from my family, how comfortable will I be? Will I be okay, and will they be okay sitting across the table from me for the rest of our lives? We will go through, many different ventures as an entrepreneur. I'm sure that this won't be the only one. So, money will come and go, but friends and family obviously is sacred, and we should treat it as such.
Right. Okay, so the other types of people that we see do these early stage investments are, angels, and I think angels is a term that's used to catch sort of a lot of different people. It can mean anything from sort of wealthy individuals who, just do these types of investments on the side. They may be people who have made a lot of money, at a tech company themselves, or, are independently wealthy from, other things they've done in their life, and they, make these types of seed investments because it's fun for them and they like to help companies grow. It's sort of like placing a whole bunch of lottery bets for them. So it's sort of one type of angel we see. The other type of angel is, kind of more formal angel networks. These are people who often band together and do these types of investments. And then you'll see sort of more professional angels, like SV Angel and people like that, who are almost sort of VC firms, but they're really focused on the very, very, very early stages, so sort of a little less formal than some of the venture capital firms. We are seeing, though, some very well-known venture capital firms who are doing very early seed stage investments, and historically, I think they weren't writing checks that small because they felt it just sort of wasn't worth their time to have to, do the diligence and, monitor an investment where they've only put in even a few $100,000. But I think there's been enough examples of companies who, maybe didn't go on to raise a ton more money, and so those very early stage investments would have been very valuable. And so I think a lot of VCs are now willing to do smaller investments at the early stage as a way to, seed some companies they may have a second chance at, or to just get in quite early. I will let Sirk talk maybe more about the financial model and some of the other prep you'll need to do here to get ready to go talk to these types of investors.
Sure. Thanks, Christine. So, when we're talking about going to talk to professional investors, obviously we're talking about, things like, preparing an executive summary, preparing a pitch deck, and preparing financial projections, right? Those are the three main things that you need to put together and be able to talk about and obviously be able to distribute. Those are things that require, an hour plus of discussion in and of themselves, and so we do other presentations. If you go onto our website, if you go onto our YouTube page, you'll see lots of presentations, a lot of the webinars that we've done where we talk about those things, where we talk about what it means to actually go out and network to meet investors, what kind of investors you should be talking to at what stages, how to put together a pitch deck, and there's also lots of information online as well. For samples. Same thing with the financial model. Really, when it comes right down to the financial model, what we should be thinking about is two things, is figuring out, okay, how much money do we need to get us to a certain point. And there's two things that we probably want to talk about. First of all, the amount of time, and we always say to people that you should be thinking about raising enough money to get you through 18 months. And the reason why we kind of look at 18 months as a target out there is because you should expect fundraising to take up to 6 months. Now, it could take shorter, obviously, but we always recommend to people that that's what they should be planning on. So if it takes you 6 months to fundraise, then having 12 months of actual operating where you're focused on making your deliverables is really, really important. You don't want to raise money, then 6 months later go out and have to raise money again. The second thing that we really focus on, and combining that with that 18-month target, is milestone financing. So we really, really stress milestone financing, and the reason for that is because the valuation of our company is not linear, and it's not a curve, right? It takes big step functions, and those big step functions, hopeful increases in step functions in terms of valuations, happen when we hit milestones. And so what we should be thinking about is, okay, this is the amount of money that we're trying to raise, this is how much money I need, and what I'm going to be using that money for. And then with that money, these are the milestones that I'm going to hit, and give yourself a little bit of flexibility, a little bit of buffer, but make sure that you can hit those milestones, because then when we go after that next round of financing, whether it's a Series A or a Series B, then we'll be doing it at a much higher valuation, and we'll be giving up less of the company. And so I know that you know that in your head, but really putting it down on paper and having the finances tell that story is really, really critical to getting the valuation and the investment that you want.
Great. So why don't we talk next about the different ways that you can structure these types of seed investments. And what we're seeing now is sort of one of two ways. One is convertible debt. People also call these, convertible promissory notes. The other is a Series seed round. And just at a very high level, let me sort of explain the differences and what gets used when. Convertible debt is it's debt. So at the outset, the people who give you the money are, they're creditors of the company, so they have loaned you money, but it does convert into equity, so into preferred stock generally, when certain things happen. And we typically see, the investment set up this way. I would say certainly almost always investments of less than $1 million are being structured as convertible debt. 1 to 2 million I still quite often will see as convertible debt, though sometimes you will see people do the Series seed in that range. And I think once you get north of $2 million, it's generally done as a Series seed round. Series seed is preferred stock, so investors they don't start out as debt holders. They are stockholders in the company from the get-go. So why would you want to do one versus the other? I think this is where the views of companies and the views of investors are a little different. I think generally companies prefer to do convertible debt if they can, and there's a few reasons for that. One is you do not have to put a valuation on the company, so you don't have to have the discussions that are either difficult or you may not be ready to have about, what is my company worth on a pre-money valuation. And as you probably know, that is, one of the very key economic things that gets negotiated with the financing, because the pre-money valuation will determine, with any given investment size, how much the investors will own of your company after the money comes in. And the pre-money valuation, there's not a lot of science around it. It's art and it's negotiated, but it takes into account the company's plans, but where you are right now, who the team is, all those sort of factors. If you're the type of company where a little bit of money is going to take you a long way, then you may not want to have that discussion or pick a number too early, because you may have to give up too much of your company for a fairly small investment. So the beauty of the convertible note is you don't have to put a valuation on the company. The money comes in as debt. The way it works, though, is that debt money will convert when you go do your first priced equity round. So when you go sell Series seed preferred stock, or if you just go straight to a Series A, and we'll talk about those differences later. But when you actually go sell preferred stock where there's a price per share, then that convertible debt will convert at that time when the other investors come in into preferred stock. And it's almost always going to be at a discount. And so that is one of the benefits you give your debt holders or note holders, is you say, okay, well, you're going to invest $500,000, and when I go do my Series seed round, if the investors at that stage are paying $1 a share, your debt will convert, but only at the rate of, let's say, 80 cents a share. And so that would be a 20% discount. I would say anywhere from 15 to 20 is very, very market, and so that's a pretty standard discount. And the discount is fair. I think it gives investors a little bit of extra return for the fact that they've given you their money early, and it's a little reward for them having believed in you so early, and so they get a discount when you actually go sell your first preferred stock round. Sometimes we hear about valuation caps, and many times companies have these in their note documents. And what the valuation cap does is it says because let's back up with the discount, right? I mean, regardless of what pre-money valuation you go get in your first priced round, without a valuation cap, the most those investors will get, your initial note holders, is a discount to whatever the price is. So if you can go get a really high pre-money valuation on your Series C or Series A, then all your note holders get is a discount to that price. And so I think some investors didn't like that. They felt it wasn't fair that they were, going to loan a company money and the company was going to go use that money to get a really high valuation, and the investors were not really going to get the benefit of that. So the concept of a valuation cap has arisen, and it's used in many of these note rounds, I think often as a bridge between the company wanting to do a convertible note round and the investors wanting to do a full-blown priced round. So the middle ground here is that when the investor money converts at that first round, it will do so at the better of, for the investor, that discount we talked about, let's say it's 20%, or a negotiated valuation cap. And so if the valuation cap in your debt documents is, let's say, $5 million, then when you go do your first price round, regardless of how much the pre-money valuation there is above $5 million, your convertible debt holders will, their shares won't be priced at higher than a $5 million pre-money valuation. So it gives the investors some certainty around the valuation at which their shares, their debt will convert into the priced equity round. I think one of the really good benefits of a convertible debt round is it's very quick and cheap to paper from a legal perspective if people respect kind of standard terms. The documents are very short. There's only a few, key things that get negotiated, and we'll get into that a little later. But they're very quick and easy to paper, so you can get the money in quickly, and you won't spend a ton of money on legal costs. I think the cons are, the valuation can be uncertain for the investors because they, without a valuation cap, they really don't know how their money will convert other than at a discount. But I think the valuation cap concept sort of bridges the gap if that's an investor's concern. But when I'm advising companies, by the way, I advise them to start the negotiations with just the discount and let the investors raise the valuation cap, and then you can deal with it then if you need to.
And Christine, I have a question here from Jonathan.
Sure.
Jonathan wants to know, how do you set a fair value cap for both sides?
Mm-hmm. Yeah, that's a difficult discussion. I think it's probably, I think some people use maybe, they would say, well, if the investors were going to invest today, what's the valuation of the company we would use? And maybe use a number a little bit higher than that. But it's something that I think the investors would be maybe a little bit higher than what they would be comfortable converting at, but it's going to be a negotiated point. I think the numbers we typically see are, between $4 and $6 million for a very early stage company. That's often the cap we'll see, because I think if you read the data out there, that's often the pre-money valuation of these types of companies when they go to their first priced round. So the investors are trying to protect themselves against, a real outlier pre-money valuation. So I think if you see a cap between 4 to 5, something like that, that's a pretty typical number.
Yeah, I think some of the other things that we see, and to Christine's point, it's really about kind of how you value yourself and how the investors value yourself. So even though you're not going to be putting a valuation during a convertible note discussion, you still should have an idea in your mind. And there's different ways that you can kind of formulate what would be an appropriate valuation for your company. And again, that's probably something else that we can have another hour-long discussion about. But yeah, for a lot of companies that Series C, the Series A financing, you're looking at a 5 to 10 million cap valuation, and so if you're getting some convertible money initially, then if you're getting it with kind of understanding that okay, we're gonna cap your valuation or the amount that you're going to be investing into our company at a valuation of $5 or $6 million, I think gives the investor some protection in case you are very, very successful, and still gives you money to grow the company to get to a decent valuation in that Series A.
Yeah, and I would much rather see my companies do notes with a valuation cap, provided it's reasonable, than have to go do a full-blown Series C round. So I really think it is a good way to kind of bridge the gap between two parties who want to do totally different types of facilities.
And we have we have another question here from Jeff
Sure.
on this. Jeff wants to know, what happens if the seed round or A round never happens for some reason? Must the company pay back the convertible note, or does it convert to equity?
Yeah, great question. I'm going to answer that just as soon as I give a quick overview of Series Seed, and I will be sure to cover that.
Great.
So I'll just give you high levels then on the Series Seed and the pros and cons, then we'll jump into a little more detail on the notes. The Series Seed is a longer process. Like we said, it's full-blown stock that's issued, and so the valuation has to be decided upon. There's a price put on the shares, and I think pros for the investors are their long-term capital gains clock starts the moment they acquire those shares, versus with the debt it wouldn't start until the debt actually converts to shares. I think the cons, the cons are you have to, put a valuation on the company to do this round, and the negotiation and legal process is more extensive. So it takes longer generally, and it generally costs more from a legal perspective. Okay, let's drill down a little more on notes, then we'll cover those questions, Erica.
And actually, Christine, just one quick thing.
Sure.
I think for some of our audience, they're very familiar with convertible debt. They could be familiar with the Series A. Series C, I know, is kind of in between the two. So could you just talk a little bit about the differences between like a Series Seed versus a full-blown Series A?
Sure. So Series Seed, and there's actually a website, seriesseed.com, that's S-E-E-D. It's actually an initiative that Fenwick and West has pioneered. And so Series A was historically a company's first priced equity round. And by the way, these names, Series Seed, Series A, they're just conventions. It's typically how people name different series of preferred stock. So it used to be you would do Series A, your next round would be a B, and then you would do a C. And now, quite often, the first round is a Series Seed, and then often followed by an A. All the seed means is you're using a slimmed-down version of the full-blown Series A legal documents. So a full Series A round, which is now being used for companies that are raising a little more money, there's 5 main legal documents. There's a certificate of incorporation, which you file in Delaware. There's a stock purchase agreement. There's an investor rights agreement. There's a voting agreement, and there's a right of first refusal and co-sale agreement. So 5, big main legal documents, plus all the kind of smaller legal documents. So that's a lot to negotiate, and there's a lot of investor rights throughout those agreements. And what the Series C docs do is they've reduced those documents to 2. There's the certificate of incorporation, which you can't get around that. You have to file that in the state of Delaware. And then there's what we call an investment agreement, and that's a purchase agreement with some of the other bells and whistles rolled into it. And so both the amount of paper has been reduced, but also the investors have a smaller set of rights and protections. And I think the thinking here is it gives the investors kind of the basic stuff they need, with the understanding, and it's actually in the documents, that when the company goes to do a full-blown Series A, and we are then dealing with the 5 big main legal documents, your seed investors will get the benefit of those at the later date. But the goal is to push off negotiating a lot of those bigger points when it's worth it, when the investors are putting in more money, and when the company has a little more money to spend on legal fees. So the Series C is really just an initiative to give investors the basic protections they need, but to do it in a really fairly quick and slimmed down way to get money in the door more efficiently. And so the Series Seed website has a term sheet on there, and it has the 2 documents. And I think there's really becoming, there's a lot of market acceptance now for these, and you'll see that people will often agree up front, we're going to do this seed investment, we're going to use the Series Seed documents, we all agree on that, and then it should be very easy if people stick to their word to move from terms to actually bringing the money in the door. There's be very little legal work involved, well, at least much less than a full-blown Series A. So great way to get money in the door quite early.
Yeah, Christine, this is just a fantastic initiative and a great move by the industry in general, and by Fenwick West, obviously.
Okay, so let's drill down a little more on the notes, and then we'll jump back to the seed. So we're back to notes. So this is debt coming in the door, and there's a few. I think we've given you. You'll see a sample term sheet on the next slide, which we'll get to in a minute. But there's there's a few key things you'll need to agree on with your investors when you're going to structure a convertible note round. One is, how much money are we going to raise? And like I was saying, $1 million and less is almost always, in my experience, done as a note these days, even up to $2 million. So you need to decide how much in total are we raising, and that money will often come from multiple people. What's the interest that we're going to be giving our investors? And the interest is not meant to, like, be a huge reward. It's just sort of meant to be, some give investors some, compensation for kind of the lost opportunity of them not having their funds. And we're typically seeing 4 to 6%. So certainly higher than, I guess, what you get in the market, but it's not a high rate by any means. The other thing you need to decide is, well, when are these notes due if they don't convert? And this, I think, goes into the question that was asked earlier, was, well, what happens if the company doesn't do a seed round or an A round? And so that's a great question, and we need to think about that in the documents, but it will depend on a few different things. Sometimes, so there'll be a maturity date in the notes, and that is, if the notes don't convert, or when is the money due? When do the investors have to be paid back? And you need a maturity date in all of these, so you need to think about how long that will be. And 12 to 18 months is almost always what we see. So if by the 12-month period or the 18-month period the company, the notes have not been converted, then your investors are technically required to be paid back. But if you get to that stage, the 12-month or 18-month stage, and you've not been able to raise a Series A round or Series Seed round such that the notes can convert, then you probably don't have money to pay your investors back, is just the practical reality of things. And technically, I guess your investors could demand the note money be repaid. They could push you into bankruptcy, but investors understand that doesn't really get them anywhere. There isn't money in the company likely, and so almost always what we see is investors agree to extend that date, and they hope the company goes and raises money, and then try and help them raise money so that their debt can convert into equity round. So it's just a situation where everyone's incentivized to try and have the company raise money, and so extending the date is really the only practical alternative at that stage. Sometimes you see a situation, though, where the company raises a little bit of note money, and then they are acquired before they do a Series Seed round or a Series A round. And so then the question is, well, what happens to that money, because it's just still sitting as debt at that point. And by the way, debt ranks ahead of equity stockholder shares. Debt has to be repaid first, actually. So that is one of the benefits of debt. So if your documents don't provide for what happens on a sale of the company before you actually do a round such that the notes convert, then all your investors would be entitled to would be principal and interest. And I think most people recognize, well, that's probably not fair to investors. If they've lent us money and we've used that money to be able to build a business in such a way that somebody wants to buy us, it doesn't really seem fair that they only get basically their money back in interest. So one of the very common terms we see, and this is the last bullet point on slide 9, is a kicker payment on change of control. So what do your investors get if the company is purchased before the debt converts? And we speak in multiples generally. So if they've loaned you $100, we see anywhere from, I would say, a 0.5x to maybe a 1x multiple, meaning if they loaned you $100 and you had a 0.5x multiple, then they would get $100 plus interest plus $50. Or if it was a 1x multiple, they would get $100 plus interest plus an extra $100. So that's a way to compensate them for the fact that they never became stockholders. Sometimes we do see, though, another way to deal with the situation is that instead of a kicker payment, the debt will convert into common stock upon the sale of the company at a predetermined valuation, probably the valuation cap. So in that case, your debt holders would become common stockholders like the founders and the employees, and they would participate that way. So that's a slightly more complicated way to deal with the issue, but we do see that sometimes as well. And that really, I think, would give your investors probably the opportunity to participate in a bigger way if it's a good sale of the company. I think one of the other key things to think about when you are setting up the note facility is what types of financings will trigger the notes to convert, and usually it has to be a financing of a certain amount of money. So $2 to $3 million is a typical number we see. So if you go raise a round of $2 million, excluding the notes typically, then in that round the notes will convert at either the discount like we talked about or at the valuation cap, whichever is better for the investors. I think those are kind of high level. You can read through the term sheet and sort of see all the things that get negotiated. Maybe we, Sirk, unless you have any points, I think I might jump into the Series C stock and talk about that in a little more detail.
No, I think that's great.
Okay. So now we're talking about seed stock again, and so this is, it's not debt, it's your first priced equity round where you are agreeing on a valuation with your investors, and we have a price per share which is based on that pre-money valuation. And so this kind of goes back to our earlier discussion about what's the pre-money, and there's a lot of market data out there, but it's going to be a function of the industry you're in and how much traction you've made and the company's plans, but it is a very important negotiated point. One of the other important points that gets negotiated with a round like this is, well, what's the size of the option pool going to be? And the option pool is the percentage of the cap table that you are setting aside for your future hires, so your employees and your consultants, people who are going to help you grow the company. And investors want to see that you have enough of the cap table set aside to be able to go out and make those hires and to grow the business the way the business should be grown. And the reason this gets negotiated is most often companies need to do an increase to their option pool at the time of the financing to make sure there are enough shares there, and so that's dilution. And your investors will almost always insist that increase be done on a pre-money basis, so that it's the existing stockholders who suffer the dilution of that pool increase. And they'll want the increase to be of a certain number of shares to usually equate to a percentage of the post-closing cap table. And this is stuff that gets modeled out, and your attorneys will likely do the modeling for you. But I think the thing to think about here is some investors just like to use rules of thumb. They'll say, well, I always want a 15% post-money option pool. And I would just not take that at face value because the dilution effect to you and your team is very real. So I wouldn't just take 15 or 10% or whatever number they're throwing at you. I think the best way to address that argument is to think about how long the investor money is going to last, and typically 12 to 18 months is when we see companies do a next round. And so think about how much hiring you're going to need to do during that window, and literally do an option budget and how many options you're going to need to give out to these key hires, and see what that is in terms of a percentage of the cap table. And maybe it's a lot less than 15 or 10%. And if that's the case, and maybe because of the fact that you need to do less hiring, or because of the type of business you're growing, you don't need to make as many hires as some of the other companies these investors see, they may be happier with a smaller pool. So I think carefully about your needs and discuss with the investors why you may need less, and see if you can get away with a smaller option pool. You can always increase it later, and at that point, everybody will suffer the dilution, not just the people who are on the cap table before the investors come in. Okay, I think I'm going to move on to let's talk about we've talked about slim down Series A. Let's talk about some of the other rights that go along with the Series C documents. I'm just going to get back on my screen here. Okay, so one of the things we see is that, as we talked about, we've omitted some of the stuff from a full-blown Series A to keep this simpler. And one of the things that is not in the Series C documents that you would see in a Series A is price-based anti-dilution, and that's protection for your investors in the event that you sell them shares at $1 and then turn around after and go sell shares at 75 cents because you're forced to do a down round, or because you want to be nice to someone. Investors want protection against that, and so price protection basically. And so that is a completely standard term in Series A and later, but you do not see it in the Series C documents. We've set up the Series C as a 1x non-participating liquidation preference. which is, it doesn't get simpler than that. That is very simple, straightforward, very founder company friendly. And so that's definitely a plus. I mean, quite often we see Series A terms like that anyways, but the Series C are set up as simple as possible. No preferential dividend rights, no redemption rights, which means the investors cannot require the company to buy back their shares. We typically, or not typically, we sometimes see that in later rounds. As a company is getting closer to an exit, some later stage investors want some certainty that they can get their money out at a certain point, but we certainly would not want that very early on in a company. We do provide for a Series C board seat. But that is something that may be negotiated here. But I think the structure we provide for is too common in one Series seed, so a board of 3, and very limited protective provisions and voting rights. One of the things that you'll see when you bring on outside investors is there's going to be a laundry list of things that you will need their approval to do. And that's very standard. You can't sell the company unless they approve. You can't issue dividends. There's just a list of things you can't do that without their approval, and that approval could be at 50% or 60%. It depends on the number, but that laundry list of items is a slimmed down version in a Series seed. And once again, that's to keep things simple and also to recognize that I think many of the things investors worry about are just generally not happening that early in a company's life cycle. So you push the negotiation of that list until your Series A. A couple other things to highlight here, and we talked about this earlier, is because the Series C is a slimmed down version of the A, the document do say, look, when you go to your Series A, your Series C investors, they'll then get the benefit of all those extra bells and whistles, so they're not going to be worse off than your new investors. The other thing that you'll see in the Series A that you will not see in the Series C is you don't always see it. There's a right of first offer on future financings, and that is, I think, built into the Series C document sometimes, but it's certainly something you definitely have to give on your Series A, although you may not on your Series C. There's more limited information rights for investors, but they do have them. No registration rights. Registration rights are things that are relevant when the company goes public. So we thought, well, that's something we can probably, wait to deal with in a Series A document because probably not a concern at the Series C stage. And there's just fewer company covenants, so fewer things the company has to do. And also no co-sale rights. So one of the things you'll see in a Series A round is the founders will be required to give the investors a right of first refusal on their shares and also a right of co-sale, meaning if the founders are going to go sell their shares, then the investors have the right to participate in that sale. So I think what you're seeing is we try to strike a balance between giving investors some of the limited protections that seem very reasonable and that they need at an early stage, but pushing off until the Series A some of the more complicated things that often take more time to negotiate and frankly are probably not as important at the very beginning of a company. And so I think the Series C is a good balance, and it's just a really efficient way to bring in a few $1,000,000 without having to spend a ton of time negotiating or have to hand over a big chunk of your investment money to your attorneys, which is not anyone's goal. So hopefully that was a lot of information. Hopefully that gives you a flavor for how we see early stage investments structured and the pros and cons of one structure versus another. But I think every company is different, so I'd encourage you to talk with your legal team about what makes sense in your situation, given the company's need for cash and how much that might be, and maybe how quickly you need to bring it in, the profile of your investors, because that will often determine which structure is going to work. So check out the Series Seed website and talk to your own legal team about what makes sense for your company when you're ready to do your first round.
Christine, that's just absolutely perfect information. I'll kind of tie it all out, from a financial perspective and from helping management, go through these decisions from an internal point of view, as well as external, is just really think about the kind of company you are, the type of growth that you expect, and the type of network and the traction that you've got. So all of these things really come together, and it should probably point towards one or the other as being more appropriate. If you've got this incredible opportunity and you need to hit it hard, you need to hit it fast, and you need money in the door, doing a convertible debt round of financing really, really quickly with minimal effort, being able to get investors in the door quickly, get money in the door, and really hit the ground running is maybe the way to go. You may have a little bit more traction, and you may be able to get a valuation, and you may have an idea of valuation that is going to be easily negotiated with investors, and it may be at a high enough valuation where you might be able to bring in equity financing, and it might make more sense for you to do that. It might give you a little bit more runway. You're probably going to raise a little bit more in a preferred round of financing versus a convertible debt. So all of these things are what you have to think about by yourself and with your team. To determine what's the best way to move forward.
Great, thanks. So we have a few questions here from the audience, and if you have more questions, folks, feel free to write them in now because we do have some time. There's two questions that kind of piggyback on each other, so I'll ask them together. First, you mentioned earlier about a Delaware C Corp, and so Josie wants to know if you can speak to what a Delaware C Corp is, and then Jeff, on top of that, wanted to know, can a California corporation do a Series seed round, or does it have to be a Delaware corporation?
Okay, good questions. What's a C Corp? Well, let's back up. So the first decision you have to make when you are setting up a company is, what type of entity am I going to be? And you could be a partnership, you could be an LLC, or you could be a corporation. And to take on outside investor money, you really need to be a corporation for lots of reasons, not an LLC and certainly not a partnership. And that's because venture capital firms will insist that you be a corporation, and they generally cannot invest in flow-through tax entities, which is what an LLC is. So if you're not a corporation, they will require you to become one, and that can be complicated and expensive. So it's just best to start as a corporation. And then the question is, well, which state do I incorporate my corporation in? And we incorporate all of our startups in Delaware, and the reason for that is, once again, it's what investors almost always require, and the reason for that is, probably any company you've heard of, with very few exceptions, is incorporated in Delaware, and that's because Delaware has, frankly, the best and kind of most sophisticated corporate law in the country, and so everyone has a lot of comfort with the rules there, with the Delaware Code, with the judges who interpret the rules. It's just a very, very sophisticated, predictable corporate structure. And it's also very easy to work with the Delaware Secretary of State because you'll learn that once you start doing transactions, you actually need to file things with the state and get documents from them. And Delaware, this is a big source of revenue for the state, so they pride themselves on, they're open super late, they turn things around immediately. It just makes business a lot easier. And so we would incorporate our startups in Delaware, and investors, if you're not there, will require you to be there. So if you start as a California corporation, at some point you will need to move the company to Delaware. And actually, as a company grows, and we do see this, sometimes we'll have companies who come to us from another firm, or maybe they've done it themselves and they're incorporated in California. And you can certainly fix it and move the company to Delaware, but the further along a company is, it actually gets more complicated and expensive because you actually have to do a merger, if you can believe that. You have to form another company in Delaware, and then you have to merge the two companies. And sometimes, contracts that you have, require consent of third parties. So it's really not always that simple to do, and it just gets more expensive the further along a company is. So I think, you do it right, and you incorporate in Delaware to start with. And if you're not there, you should move to Delaware as early as possible because you're just really putting off the inevitable and putting off an expense that will be growing. Just as one data point, I know Kleiner Perkins in their very standard term sheet, the first point on the term sheet is, if you're not already, you have to be a Delaware corp at the time of the investment. So they just put it right out there. C Corp versus S Corp, also a great question. That is a tax issue. Maybe I'll let Cirque speak to that, but that is it's just an election made on your tax form. And I think when you're an S Corp, you're still a corporation, but you basically are getting the flow-through tax treatment or benefits that an LLC would have. And so that it's not really, companies can do that at the beginning, but you very quickly would lose your S Corp status because there are certain requirements you need to meet in order to preserve your S Corp status. One is, I think all your stockholders have to be natural persons, so real people, not entities. So typically, the second you take in investor money, they're an entity, so you would lose your status then. I think you can't have more than one class of stock. Mm-hmm. So once again, common stock is okay at the beginning, but the second you have preferred stock, you've also lost S Corp status. I think all your stockholders have to be U.S. residents. So if you have somebody who's a foreigner, you would also lose S Corp status. So I have some companies who do the S election at the very beginning, I guess to take advantage of losses, but they very quickly will lose the benefit of that. But net Delaware C Corp is, from our perspective as startup attorneys, just non-negotiable. It's how we set up all our companies, and it's what investors expect.
Yeah, I think just from an experience standpoint, probably of the companies that I've worked with, maybe 1%, are non-Delaware corporations, maybe a California corporation. And like you said, not only is it more costly later on to make the change, but even initially, right? Delaware makes it so much easier for actual company and its representatives to do business, to do the filings on an annual basis. The franchise taxes are less in Delaware than in California. There's just no reason, no logical reason that you'd want to incorporate in California versus Delaware.
Yeah, and to add on that, I mean, if you're based in California, as many of our clients are, you are what the California Secretary of State considers, a foreign corporation, meaning you're incorporated outside of the state of California. And so because if you're headquartered here, you do have to also register with the California Secretary of State. That's a very simple filing, and it's an annual thing you renew. So yes, you will also have to pay, extra money to the California Secretary of State in addition to Delaware. But it is, in the hundreds of dollars range. It'd be penny wise and pound foolish to incorporate outside of Delaware to try and avoid that small extra fee, because you will spend very high multiples of that later to try and clean things up. So, I just tell my startups, look, if you want to be a certain kind of company and you want to be high growth and venture backed, there's certain things you have to do, and you have to look and feel a certain way, and it may mean a little more money at the beginning, but that's just a cost of setting up your business the right way and setting things up for success early on.
Great. So we have a ton of questions here and not too much time. So I think what I'll do is I'll try and get through the ones that are most relevant to the presentation today. And then we have some more general questions on fundraising that I might ask as well. But just a note to all you in the audience that if you have asked a question and we don't answer it, we will follow up again through email. So Preston wants to know, in the fundraising life cycle, when is the right time to incorporate? Is it during bootstrapping but before a note equity? Or is there a benefit to waiting to incorporate when you have a lead investor so as to minimize legal costs?
Great question, and the very clear answer is you should incorporate as soon as possible and not wait for investor money, and there's a bunch of reasons for that. First and foremost is you want to do your incorporation at a time when you're able to distance it as far as possible actually from outside investment, for a few reasons. One is you just want to have everything up and running. You don't want to be trying to incorporate and raise money and do all that at the same time, and it just complicates things and will really drag up how long it takes to bring in your investor money. More importantly, though, is you want to set up the company at a time when you can issue the founder stock at fractions of a penny. So really when the company's not worth very much, because founders actually have to pay for their stock, and I think that comes as a surprise to many people. And so you want to do it at a time when the company does not have a lot of value, frankly, and you can issue founder stock at fractions of a penny, and so the repurchase then with the vesting will be at fractions of a penny. So, the second you decide you're going to, go ahead with a business, you should talk to a startup attorney and get yourself incorporated. The incorporation process does not have to be very expensive if you set it up in a kind of plain vanilla way. And there are lots of firms out there, Fenwick included, who have come up with creative, deferral arrangements so that you can get, you can get incorporated and get your basic legal stuff done at the beginning, but put off payment until you raise money. So there's really no good reason to put it off. I would do it as soon as possible, and also start to build a relationship with your attorney, because it's a relationship like anything else, any other relationship in your life, and it gets better over time, and you get to know each other, and you learn how to work together. So you want to start that relationship early and not be figuring out if your attorney's the right attorney, while you're trying to raise money. So go incorporate today, I guess is what I'm saying.
Okay, great. Thanks.
So I'm not sure if you have any thoughts on that as well.
No, I agree 100%, and I'll even kind of add to that in terms of the relationship part of it, because this is really critical, right? I mean, whether you're looking to fundraise today, whether you're looking to fundraise 12 months from now, you should be thinking about it now. Right. So obviously, if you're looking to raise funds now, you're already thinking about it, day and night. But even if it's not going to be for 6 or 12 months from now, it's really, really important to start establishing your network as early as possible. And as a startup looking to raise financing, you should be part of kind of the ecosystem. You should be part of the startup ecosystem, and that means working with attorneys who are very, very familiar with the process as well as the players. It's working with bankers who are very, very familiar. So one of the things I always tell people is, if you're banking with Bank of America or Chase or somebody like that, national firm that really don't work with startups, that's the wrong bank, because they're not going to be able to help you when it comes time to fundraise and make introductions for you. So work with a bank that focuses in that area. And then as a little bit of a plug to early growth, I'll say the same thing about accounting firms and HR firms and other types of firms. You should be one of the first questions you should be asking when you're talking with these service providers and partners is, what are you going to be able to do for me, not only from the service that you provide, but ultimately when I'm looking to raise funds, are you going to help? Are you going to be able to make introductions? Are you going to be able to help me during that process? That should be absolutely one of the, not only the value adds, but one of the critical things that a service provider should be doing for you.
Great, thanks. I'm looking through, it's great. We've had such an engaged audience here. We have so many questions. I think that so many of these are kind of particular to the company, to the person who's asking. So I think we will follow up with these separately. I just feel like some of these are too narrow to get into, and some are too broad to try and address in the last minutes of this presentation. And I think that's a good wrap up that Sirk and Christine just provided. So you will receive a follow-up with the recording and with the slide deck, so you can review it again. You can see the contact information here, so feel free to reach out to Christine or Sirk if you have follow-up questions. And if you have any that we didn't get to today, you can expect an email within the next few days following up on that. So thank you all so much for joining us today. I hope you found it useful. I think this was just great information. Thank you so much, Christine and Sirk. We really appreciate your time and the time of our audience as well. And I just want to let you all know that we do have another webinar coming up on August 28th, and that's on how to set up your startup accounting with Sirk Rowe again, our COO here. If you enjoyed listening to him, join us on the 28th for more information. So we hope you can join us for that one, and if not, you can check out our events page on our site to see other upcoming webinars we have and other events, and we hope that we will connect with you soon. So on that note, thanks again, Christine and Sirk, and have a wonderful day, everyone.
Thanks, everyone.
Thank you, everyone. Happy fundraising.